If you don't have a 401k at work, or even if you do, an IRA might be one of the best retirement savings tools available to you.
But most people don't fully understand what an IRA is, how it works, or whether they should have one.
I'm April with White Oak Planning.
And I'm Jerry. Today we're breaking down IRAs so you can decide if opening one makes sense for you.
So what is an IRA?
IRA stands for Individual Retirement Account. It's a type of investment account designed specifically for retirement savings with tax advantages.
And unlike a 401k, which is offered through your employer, you can open an IRA on your own. You can open one at a bank, brokerage firm, or robo-advisor.
Once you open the account, you contribute money to it and choose how to invest that money. Common options include stocks, bonds, mutual funds, or ETFs, for example.
The tax advantages make IRAs powerful. You'll either get a tax deduction now or tax-free growth, depending on which type you choose.
There are traditional IRAs and Roth IRAs.
With a traditional IRA, you contribute pre-tax dollars. You may get a tax deduction for your contribution, depending on your income and whether you have a retirement plan at work. The money grows tax-deferred, and when you withdraw it in retirement, you pay income taxes on those withdrawals.
With the Roth IRA, on the other hand, you contribute after-tax dollars, no tax deduction now, but the great thing is the money grows tax-free, and when you withdraw it in retirement, you pay no taxes on those withdrawals.
We covered the Roth versus traditional decision in another video, so check that out if you want to dive deeper. The short version, if you think your tax rate will be higher in retirement, Roth is often better. If you think your tax rate will be lower in retirement, traditional is often better. Let's look at contribution limits.
For 2025, you can contribute up to $7,000 to an IRA if you're under 50. If you're 50 or older, you can contribute up to $8,000 thanks to the catch-up provisions.
These limits apply to the total across all your IRAs. If you have both a traditional and Roth IRA, your combined contributions can't exceed $7,000 or $8,000.
Contribution limits typically increase over time with inflation, so check the current limits each year.
One more thing, to contribute to an IRA, you need earned income. If you don't work, you generally can't contribute. However, if you're married and your spouse works, they may be able to contribute to a spousal IRA for you.
Roth IRAs have income limits. If you earn too much, you can't contribute directly to a Roth IRA.
For the year 2025, the income phase-out for Roth IRA contributions starts around $150,000 for single filers and $230,000 for married filing jointly. Above certain thresholds, you can't contribute at all.
Traditional IRAs don't have income limits for contributions. You can always contribute to a traditional IRA, but whether you can deduct the contribution depends on your income and whether you have a retirement plan at work.
If you earn too much to contribute to a Roth IRA, there's a workaround called a backdoor Roth IRA. This involves contributing to a traditional IRA and then converting it to a Roth. It's a bit more complex, so you'll want to work with a financial advisor or tax professional if you go this route. So when can you withdraw?
IRAs are designed for retirement, so there are rules about when you can withdraw the money.
With the traditional IRA, if you withdraw before age 59 and a half, you'll typically pay income taxes plus a 10% early withdrawal penalty. There are exceptions for things like buying your first home, paying for education, or certain qualified medical expenses.
With the Roth IRA, you can withdraw your contributions anytime without taxes or penalties because you already paid taxes on that money. But if you do withdraw the earnings before 59 and a half, you'll pay taxes and penalties unless you meet certain conditions.
Age 73, traditional IRAs require that you take required minimum distributions, or RMDs. That time depends on when you were born. Roth IRAs do not have RMDs during your lifetime, which makes them a valuable estate planning tool.
So why would you open an IRA?
First, if you don't have access to a 401k at work, an IRA is one of your best options for retirement savings.
Second, even if you do have a 401k, An IRA gives you more investment options. Most 401k plans have a limited menu of funds to choose from. With an IRA, you can invest in almost anything: individual stocks, bonds, ETFs, mutual funds.
Third, if you've maxed out your 401k contributions and want to save more for retirement, an IRA can be a great next.
And finally, Roth IRAs can be valuable for estate planning because they don't have RMDs and can pass tax-free to your beneficiaries.
If you're a blended family, IRAs can help you coordinate retirement savings across different employment situations.
For example, one spouse might have a 401k at work while the other is self-employed and uses an IRA. Or one spouse might focus on a Roth IRA while the other contributes to a traditional IRA for tax diversification.
The key is looking at your retirement savings as a household and making decisions that complement each other. Here's your action step. If you don't already have an IRA, consider opening one. You can open an account at most major brokerage firms in just a few moments.
Decide whether traditional or Roth makes more sense for your situation. Set up automatic contributions if possible, and choose your investments.
And if you want help building a comprehensive retirement strategy that includes IRAs, 401ks, and other accounts, schedule a complimentary Connect call using the link below. I'm April with White Oak Planning. If this has helped you understand IRAs, subscribe and share it with someone who wants to start saving for retirement.
And I'm Jerry. IRAs are one of the most powerful retirement savings tools available. Take advantage of them. We're White Oak Planning, helping blended families build financial confidence and grow stronger together.